it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. I wanted to go back to basic economics. I know, basic economics, economics 101, to show you why the real estate market is like it is today, which is basically very low supply, but fairly high price, right? So why is that, Jack? That doesn't sound like a healthy operating market, and it's not. So let's take a look at what's going on. You remember the good old price and quantity chart from basic economics, where as price goes up, the supply goes up, and supply and demand meet in the middle. This assumes everyone's working in their own enlightened self-interest without much or very little government interference in the marketplace. And prices are moderate, somewhere in the range of moderate, and supply is somewhere in the range of being moderate. Economists call this an equilibrium, and that's what this chart shows, an equilibrium. Everyone's in the happy middle, but that's not what's happening in the marketplace right now. There is no happy middle right now in the housing market because of government's involvement in the cost of money. The cost of money, in other words, the mortgage rate. Because the Federal Reserve kept interest rates artificially low for about 15 years, it suppressed the rate of interest that most people are paying. Most people are paying an artificially low rate, an historically low rate as defined by this graph, which we showed in a video a couple of days ago. I'll link somewhere for you. But it does show that the vast majority of people who already have a mortgage are paying well below 5%. Some people are paying below 3%. Consequently, their interest in selling is also suppressed. Think about it. If you have a 4.1% mortgage now, or 3.7%, now that rates have normalized, why would you refinance? And or what we're especially talking about, why would you sell in order to buy a new house at a much higher rate, which is going to be well into the 7s? Why would you do that? Your payment's going to be much higher to get this different house. You might as well just stay where you are. So, going back to the whiteboard, that's going to radically change our supply curve. Radically change our supply curve. There are still some people that have to sell because they get transferred to Milwaukee, or they got divorced, or they passed away, and now their family has to sell. There's still people that have to sell, but there's a whole mess of people that are just like, we're just going to stay where we are, honey. So there's a new supply curve, and it looks like this. Whoa, that's a steep supply curve, Jack. Yes, that's a very steep supply curve. It's really not providing more supply as very little. Like, as price goes up, there's not a lot more supply because of the cost of transferring from one property to another. Okay, Jack, so what about demand? Well, when the price of money goes up, demand is going to go down. So we have a very steep demand curve. And there's our demand curve there. It's kind of the opposite of the supply curve. Very, very steep. Consequently, reading the chart, what we end up with, that's right, class, we end up with high prices, but also low quantity, right? So we're way off from the middle of the chart like we were when we started off, remember? When we started off, we were more like the red lines where things were kind of like in the middle. And now, because of this interest rate lock, as they're calling it, now our curves are completely distorted. And this is the market that we find ourselves in across the country. Well, Jack, why don't they just cut interest rates and make everyone happy again? Well, because that would be incredibly inflationary, and we didn't get to this point overnight, and we're not going to get out of this overnight either. It took 15 years to get a chart to look like this, where all your existing mortgages are kind of under 5%. It's going to take a long time to kind of undo this chart. So in order to move this chart back to kind of the middle, That's not going to happen overnight. We might see some gradual progress, but it's not going to just be like flicking a switch. Consequently, we might be in for a marketplace with lower sales numbers for quite some time. Now, if you're selling and you don't have to buy something new for whatever reason, then you'll probably be just fine. Then the rate differential doesn't bother you. Or if you're moving to some place which is incredibly less expensive than your current community, then also this might not bother you as much. But most people can't do that because of social reasons, family reasons, cultural reasons, work, a lot of different reasons. You kind of want to stay in the same market or the similar type of market. And for buyers, this indicates that affordability, the affordability index, will continue to be very, very high unless, once again, you consider moving to some part of the country which is a lot less expensive. The problem with that, of course, is in these conditions, there are a lot of other people who are thinking about moving to someplace that's a lot less expensive. And when a lot of people move to someplace that's less expensive, guess what? That's right, it quickly loses its affordability. All right, for now, I'm Jack from Jack Gately Real Estate and the Online Real Estate Academy. Have a great day.